Hi, this is Daniel with Unrivaled Investing. Today's video is an uncut edition. Usually you have these much more sculpted videos where I'm talking about the market or individual companies. This is an uncut, sort of a personal dialogue sharing how I'm doing, where I'm at, and you can just hear my thoughts unscripted. Let's go. So first item is this disclaimer. You can read it on your own time. Next is what's the value that I'm trying to bring to you. The first is finding potential multi-baggers. What you see online is you have a lot of folks that put, their content, their great ideas behind the paywall. My view is, there's no reason that shouldn't be shared with the masses. If you're interested in potentially learning about companies that can go up hundreds or even thousands of percent, why not make free videos where I'm breaking down the company, their value proposition, their market, so that way you can see it for free. All you have to do really, if you want to see them, is just subscribe, hit that like button, so that way you can know and spread the word. The great companies that can go up thousands of percent shouldn't be limited just to a few people or a few hedge funds. It would be good for the public investors to know as well. So that's the first part, is helping you find those potential multi-baggers. And then the next is sharing the personal journey. It's not just, hey, these are some stocks that I think are interesting. Hello, Kitty. You interested in saying hi too? So it's not only just about my own personal journey. As you can see, there's a personal aspect to life. But it's showing like, hey, like if I'm talking about these things, or I'm pumped about this, or these are some of the things I own, you can see, am I going up, am I down, how am I doing year to date? And if you want to see the super detailed version behind the portfolio, that is behind a paywall. But that's only, if you want to see and try to like follow my journey, some sort of like digital hand holding, like, hey, we're in this together. Like, he's down, I know why he's down. Here are his thoughts on his holdings. So that's up to you if you're interested. Otherwise, I feel like the most of the value is in creating these videos that talk about multi-baggers, and there'll be another one coming up, later this week. So how am I doing year to date? You can see here, year to date, I'm up a little shy of 20%. Yeah, it's okay. It's pretty good. I'm pleased but not satisfied. I'll talk more about this later. I think I could have done a lot better. And I think this cat thinks I could have done a lot better too, right? Yeah, you could have done better. So that's just the reality. And we'll get into that more in a second. So if you're interested in following my specific journey in terms of what's driving that year-to-date result, just go to unrivaledinvesting.com. You click on this one, which is Journey, and that's for the do-it-yourself investors. Because this is me just sharing my personal story. This has nothing to do with my business. This is just my personal story. How am I doing as an investor personally? How's my personal portfolio tracking? And so you click on Journey, and then that you can go down here for the price of a cup of coffee. You subscribe, and you can see the detail. You can see what I bought in a given month, what I sold in a given month, sort of what are my thoughts behind it, what's my portfolio allocation, what do I think of the valuation for some of my top holdings. So I'm trying to, if you're interested in seeing the detail, you can. It's up to you. Next up, what's driving my year-to-date performance? A little under 20% positive for the year versus the S&P 500, which is actually down single digits. There's really two components. The first is e-commerce plays. I owned a couple of e-commerce companies. I owned several e-commerce stocks in several e-commerce companies, but three in particular helped drive a significant percentage of my returns so far this year. And what's interesting is if you look back and study the history of e-commerce, you see like JD.com, it really launched and got started with the growth of SARS. Before that, it was much more offline business. And so if you're a student of history, you'll understand and it would expect that as this global pandemic hit, you would expect to see some sort of acceleration in your growth. So e-commerce was already winning beforehand, because in each case I thought they had an unrivaled value proposition, and I thought they had this wide open market. But having a global pandemic where everyone's like, oh, how do I make money in this market because everything else is getting hammered, that sort of put everyone to start thinking like, hey, what stocks can I buy right now that'll make money? And so that they've gotten juiced up, some of them on valuation. Others are just compounding and doing well on their own. The other aspect to my personal investment journey is hedging. And I've held market hedges for a little while, and they actually made some money during the downturn in March and April. And most of my portfolio, I'm focused on sort of the buy and hold approach. It's really more buy and verify. You have this full spectrum of passive versus active. I don't really consider myself either. I enjoy learning about companies as a hobby. That's sort of what I do in my free time. Any limited free time I have, it's learning about companies and who has, and trying to suss out, like, do you have an unrivaled value proposition? How big's your market? How fast are you growing? So that's sort of like that's what I'm doing. But a passive would be like, hey, I just bought this S&P index, or this index. It owns 2,000 companies or 500 companies, and I'm just going to sit on it. And there's real downsides to that, because if there is a possibility, if you don't know what you're doing, that you're buying into this index and your money doesn't go anywhere for a few decades just because the index is so expensive. And that's happened a couple of times throughout history. So, people that think, oh, if I just buy an index, I'm going to be fine over time, that's actually not true. You can go decades without going anywhere. So that's the first, that's passive. On the active side, that's like, hey, how's this company going to do? Is it going to go up on earnings? I'm not doing that. I'm very, it's from my perspective, it's sort of passive. Like, hey, how did my ownership in this company do? Like, how is this company doing? Does management seem like they're doing reasonable things? So it's just reading, their transcript, sort of following what a company does each quarter, and that's doing it in my free time, learning about these companies. So I would put it as neither passive or active, but the bulk of my portfolio is buying things where it's buy and verify. So effectively buy and hold, where I'm not looking to sell them for a long period of time, because one, I'm trying to find things with an unrivaled value proposition, and as long as you have an unrivaled value proposition, you should continue to grow, assuming it's a growing market, assuming it's a big market. You should be able to grow over long periods of time. So it's really just buy and verify. And then the hedging, that's different. The hedging is something where it's more based on, like, hey, what's the pricing dynamics of the underlying indices? Where maybe I'm trying to just sort of hedge my downside risk if there's a big collapse coming. And honestly, I don't really like the investment setup right here. And you can see one of my videos about that. I did a video about incoming crash, but that's it. It really sort of details, like, what are my concerns, and why why is there not really a great setup here? But you can watch that video for that download. So next, thoughts on the setup, or where we are right now. I'm a little bummed, in all honesty, that I wasn't more aggressive earlier this year. There were several positions that are up over 100% since earlier lows, and from when I bought them. In some cases I bought teaser positions, and I should have bought maybe a full position. And so that's a little frustrating to me personally, just because if I had made fuller positions instead of having a large cash balance at all times, and I continue to have a large cash balance. If I had made, instead of teaser but a full position, instead of being up just shy of 20, maybe it would be up 40 or 50. And I certainly know some accounts that are up 50 to 100% this year, because they made big bets in these e-commerce companies. Or these tech companies, or these SaaS companies, and you've had the inherent growth in these businesses, but these businesses had this huge valuation uptick. And the danger in this market is that a lot of people think they're a genius because you can just buy a growth company at any price, and the reality is you can't. If you buy at too high of a price, even if it's a great growth company, there's a chance you have no returns over a long period of time. So this is, I sort of view this as a dangerous territory that we're in. Maybe we continue to make money. Maybe the market keeps going higher, but there really does seem to be a disconnect. Once again, I talked about that in that incoming crash video. You can check it out if you want. Also, valuations really aren't that compelling. No matter, you can't find stocks, even if you're looking at these crazy growth companies, they're growing 100% a year in terms of revenue or their fundamentals. Like, even if you were to do some sort of like virtual earnings multiple, you're not going to find things that are like trading on a virtual multiple of like 20 times. When I say virtual, I'm talking about, like, hey, here's what the margins could be if the business was at scale. And that's sort of the way that you think about valuing some of these growth companies. And the challenge is, even when you're using virtual multiples, some of these things are just super duper expensive. And once again, it's this combination of investors think they're genius for buying growth companies, when in reality, most of the return is driven recently has been driven by valuation expansion. And the problem with valuation expansion is that long-term valuation expansion gets wiped out. Long-term, it's driven by earnings earnings gains? What are the fundamentals of the business, not just valuation? Did the stock go from expensive to crazy expensive? So right now, I'm not finding the companies that are super duper compelling. And honestly, even at the lows, it's not like the stock market was super cheap. In March 2020, there were a couple of companies that were cheap here and there, but they were tied to cyclicals where it's like, hey, hopefully the economy survives. So then they get a massive bid up since then. But by and large, companies were not dirt cheap then. Also, the setup, and I talked about this in the incoming crash video, the setup by the Federal Reserve is just terrible for investors. You have anemic bond returns. The spreads are really low. It's not like you can go to junk bonds and get 10% a year. It's like 4% or 5%. It's terrible. Cash is yielding nothing. So you're getting the steady torture of, as there's inflation, you lose, your purchasing power every year. And then lastly, stocks are expensive. So that, the last option is maybe you own some sort of commodity. Chamath Palihapitiya talks about owning Bitcoin is schmuck insurance. And what's that even mean? It means like, hey, you have Federal Reserves around the world, central bankers that are, printing tons of currency to help their economies, and they're debasing their currency. So this is schmuck insurance against all these central bankers from doing that sort of thing. So Bitcoin should catch a bid. And I sort of feel like commodities, or gold in particular, probably would catch a bid in that sort of scenario. Once again, it's a really challenging time, I think, for professional investors across the board, let alone personal and individual or retail investors, just because the Federal Reserve is creating a really tough setup. Lastly, if you're interested in seeing these videos, once again, I talked about at the beginning, like, look, my goal is to help post videos that are educational for you. This is not investment advice. This is supposed to be educational content where I'm trying to, find companies that could potentially go up hundreds or even thousands of percent. If that's something you're interested in, please subscribe, so that way I know there's actually a market for this thing. Because right now, the way most people do it is they put it behind a paywall. So hit that like button, hit subscribe, and thank you so much for watching.